if we were to take the monetary base and take all the value of that in dollars, and then the tiny amount of gold it has on its balance sheet, 235 million ounces, if we are to equate the dollar value of those 235 million ounces to the rest of the pile on the balance sheet, which is the monetary base, it would have to be 30 to, I think it's about 50,000, or it could be 55,000, it's somewhere around there, like between 40 and 50 or something like that. It doesn't really make a difference, but that's what we're talking about. I'm not talking about covering M2. I don't think we're going to get there, because to cover M2 is what, like 21 trillion, whereas the monetary base is like 5.6 trillion. It had to be 4 times that. I don't think we're going to see $200,000 gold. I think the dollar's going to break before that. So that's the calculation we're talking about.
Gold revaluation isn't just a theoretical idea. It has already happened more than once in history. Rafi Farber, also known as the Endgame Investor, explains that gold has always been money, while the dollar is simply a derivative of it. That's a hard concept for most people to hold on to, because we're conditioned to think in dollars. But when gold's price rises or falls, what's really happening is the dollar itself is being revalued. Now, there are 2 types of revaluation: statutory and market-based. In 1933, FDR statutorily revalued gold from $21 to $35 an ounce, which led to a surge of inflation within a year. By contrast, in 1980 the market revalued gold on its own, pushing it up to $850 per ounce, because people lost trust in the Fed's balance sheet. In both cases, it was the dollar, not gold, that changed in value. Here's the key: based on the Fed's balance sheet today, gold would need to trade around $40,000 to $50,000 an ounce just to properly back the monetary base. And while that sounds extreme, Rafi points out, it's happened before. If it happens again, it won't mean free money. It will mean a massive reset in how every other price in the economy is measured. The bigger danger? Policymakers may not even realize that gold is money. They may see revaluation as nothing more than a clever trick to unlock spending power, without understanding that it would unleash rapid inflation and destabilize the dollar itself. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
I want to talk about this in the context of course, gold being money and the dollar only being a derivative of it. And that's always hard. I keep going back to that because that's the number one message, but it's hard to keep it in your head. And to take it seriously, like people treat it like, oh, it's just a religious statement, like, God is one, whatever, but you don't really know what that means. But you have to understand what it means that gold is the money. If the gold is the money, then every time the price of gold moves, it's revaluing the dollar. Gold doesn't actually get revalued. The dollar is being revalued. Now, the question is, are we talking about statutory revaluation or market-based revaluation? You just cited 2 examples, one being 1933, which was statutory, right? FDR just decided, maybe on some advisement, maybe on a whim. I remember I read when I was turning libertarian when I was younger, I was reading one of Glenn Beck's books, decided if he's the path I wanted to go on. Ultimately, no, he wasn't. He was an influence, but I never really went down his path. But he was talking about, I think in his book, Broke, how FDR just decided on a whim to make it 35. I don't know, he was just like flipping numbers in his head and he decided that was the one. Could be true, I don't know. And then you were talking about the revaluation in 1980, where the price of gold in the market that you could get a gold coin for to shop was what was being revalued, and that hit 872 or 850, wherever you want to count the top. And ultimately, these are really the same thing. Right, they're brought about in different ways, and that's but they are monetarily speaking. What is happening in the monetary system? It's the same thing. It just the difference is who's acting upon it. Like if a 50-kilogram weight drops on your head, you're not going to really care that much if it was, like, say, a meteor from God. Or let's say somebody had sinister would drop something on your head from 100 feet above you, or drop the piano on you. Either way, you're dead. It doesn't make a difference. So I don't think we're going to have a statutory gold revaluation. And what happens during a statutory gold revaluation? Well, you look at the price inflation statistics, which we have from the 1930s. And in April 1933, I think the deflationary, and I'm talking about consumer prices, The deflationary statistics were something like negative 9% a year. And then by about 10 to 12 months after the revaluation from 21 to 35, price inflation shot up to positive 10, 15% or something like that, like a huge move. And really that was the point, because by revaluing, that gave FDR's government, or the Fed under him or beside him or whatever, the ability to print more money based on that gold revaluation, and then the inflation came from there. But in 1980, it was by the market itself, when the market decided that the other stuff on the Fed's balance sheet was not trustworthy. So it bid up the value of the gold to back the rest of the assets on the Fed's balance sheet, which is mostly debt, to 100%. And that made the rest of the debt trustworthy. Now the question is, what percentage of gold backing the rest of the Fed's balance sheet would make the rest of the treasuries trustworthy to hold for people? And if we go to the 1980 numbers, it's something like $40,000 to $50,000. So people think of that number and they're like, oh, this guy's a crazy gold bug. But it happened before. And once it happens, I'm going to get rid of my gold. I'm going to buy stuff. I'm not going to buy dollars. I'm not going to sell it for dollars. I'm going to buy things. And I'm going to call it the end of this game. I'm going to move on with my life. And we'll see what I do after that. But I know where the bell is, because we've had 1980. So that's what I'm waiting for. It's not dollars. There are different kinds of dollars out in existence. Right? There's the monetary base, which is the stuff that's on the Fed's balance sheet. Like when the Fed buys an asset, it creates new dollars and gives them to whoever gave them the asset. That's base dollars. And then you have commercial bank deposits, which are created through loans and other activities, which are built upon that base. So the number 40, 50,000 is based non-commercial bank money and not on the M2. The M2 is base money plus all the loans that are made piled on top of it. Just talking about the monetary base. The monetary base itself is the balance sheet, and all the assets on the balance sheet. And then you have a little bit of gold, 235 million ounces, the unaudited, whatever. Let's just assume it's there. So if we were to take the monetary base and take all the value of that in dollars, and then the tiny amount of gold it has on its balance sheet, 235 million ounces, if we are to equate the dollar value of those 235 million ounces to the rest of the pile on the balance sheet, which is the monetary base, it would have to be I think it's about 50,000, or it could be 55,000, somewhere around there, like between 40 and 50 or something like that. It doesn't really make a difference. But that's what we're talking about. I'm not talking about covering M2. I don't think we're going to get there, because to cover M2 is what, like 21 trillion, whereas the monetary base is like 5.6 trillion. It had to be 4 times that. I don't think we're going to see $200,000 gold. I think the dollar's going to break before that. So that's the calculation we're talking about. Right. There is no getting the government's fiscal situation under control without destroying the banking system. The government, it's hard to say how much they believe in what they're saying, these position papers, and how much is propaganda and how much they're just making it up. I don't know. But the way that they're thinking about it, they say, look, we have this gold. It's not really 42. If we just stop lying, then we have all this free money and we don't have to raise taxes and we don't have to increase the debt. It seems like free money, right? How could you go wrong? And if you don't understand that gold is money, and if you revalue the gold dollar ratio, you're not changing what money is, you're changing what the dollar is. And if you change what the dollar is, that affects all prices down the line very quickly, not overnight, but within, months. When FDR did it, it was a 66% revaluation. It took about a year to get to maximum price, consumer price inflation. So if you don't, I don't think anyone in the government understands that gold is the money right now. And because they don't understand that, they see this as like a mathematical trick that can just, give them manna from heaven, free money. And they say, like, why don't we just do that? And then the only reason they don't, I think, is because maybe there's some traditionalist people, or maybe they don't fully buy into their voodoo. And they're like, maybe this is not such a good idea. It's like Louis C.K.'s famous comedy bit, of course, but maybe, of course, free money is great, but maybe destroying the dollar isn't such a good idea. They're not sure about it. So we'll see what they do. And if they don't do it, the market's going to do it anyway.
Rafi says when we start playing the inflationary game, it quickly becomes a battle between the currency and the banks. You can save one, but not both. He explains that this has been the case since the 1933 revaluation, with the Federal Reserve constantly juggling the pyramid, raising rates when consumer prices accelerate and cutting them when inflation cools. Rafi emphasizes that this system only works as long as productivity keeps growing. He uses the analogy of an apple or orange tree. If production is strong, you hardly notice when someone takes some fruit. But as government demands more, productivity can't keep pace. That's when cuts happen even as inflation rises, and that's where we are now. Rafi adds that Powell recently hinted at avoiding cuts because prices were rising too fast. Yet days later at Jackson Hole, he announced cuts anyway, sending gold and silver higher. For decades, cuts came during recessions when prices cooled. Now they're happening in an environment of rising prices, risking either hyperinflation or banking collapse. Rafi stresses that in both outcomes, purchasing power flows into gold and silver. Holders of real money are protected. Let's get back to the interview.
That's always the either or. When we start playing the inflationary game, you are playing the game of the currency versus the banks. You can save one but not the other. And now as you go up the pyramid, you can juggle, right? So as we go up the pyramid, this pyramid, let's say it started in 1933 with that initial revaluation, then you can juggle that pyramid and only hike when price inflation goes higher, when consumer prices go higher faster, and cut only when they stop accelerating as fast. And the reason you can keep juggling is because of the analogy that I often use, the apple tree, the orange tree in your backyard, right? If you have incredible production, you don't notice that your neighbor is stealing from you. But if your neighbor invites his cronies to his your backdoor neighbor, and they want to eat more and more and more oranges, which is the equivalent of the government growing bigger and bigger and bigger, because that's how it always happens, then you can keep consumer prices lower by increasing productivity. But there's a point where you can't increase productivity any longer, and you're overburdening the slaves, and they can't make the tree any more productive. So at that point you have to start cutting into an accelerating consumer prices environment, which is where the Federal Reserve is headed now, because this is what just happened like a week or two ago, right? They were urging Powell the Trump administration was urging Powell to cut, and he was saying, he hinted no, he's not going to do it because consumer prices are rising too fast. And then he came out in Jackson Hole and said, well, we're going to cut now. And then gold and silver jumped. Consumer prices are rising faster than at any time from 1980 to just before COVID. So they're going to be cutting into a higher consumer price environment, and that means they will destroy the currency. Until now, they've always only cut into what they call recessions, when consumer prices stop rising and you have this huge banking crisis. So you can pick, I'll save the banks, and the currency will level out in consumer prices. But now they can either trigger hyperinflation by cutting to zero in an environment of very fast rising prices, or they can not cut at all and let the banks fall, and then everything goes with it, and all prices fall, consumer prices too, but they fall the slowest compared to everything else, including assets like stocks, bonds, Bitcoin, all those other things. Consumer prices still fall, but however it goes, it doesn't make a difference for gold and silver holders, because all the purchasing power goes into those metals anyway. Okay, so I'm guessing here as to a causal or a rational, let's say, Austrian view of what is going on, or a positivist view. You try to link it up to why humans would behave in such a way that this would precede a financial crisis. So I think what you're talking about is, there was a chart that I saw on Gold Charts R Us of the gold maturities from spot all the way to the farthest out future, and I noticed that in 2007 up to the 2008 financial crisis, the spread really got pretty thick, right? And also in 2019, from the repocalypse, from when the repo rates started to spike up and the Fed had to restart QE, until and especially through 2020 during the lockdowns, they really got pretty thick also. And they're doing it again. It's been that way since, I think, 2023, since the regional banking crisis. I might be a little bit off on the dates. I haven't seen the chart in a while, but why would this be? And I don't have a perfect answer, but if there are problems with the dollar, then what you would see is spot gold going pretty high relative to other maturities, but going out into the future like I think you would compress in the middle, and then the price would go higher out into the future because you'd have speculators that are also worried about the dollar, because they want to they're using gold to speculate because they see something wrong with the dollar, but also you have the people at the mouth of the pipe, the big banks, and they are going after spot gold itself. So you're having these like kind of zigzaggy, wavy maturity scheme. And I think that's what's happening now. But you'd have to look at a chart of this. It's available on Gold Charts or us to see all the maturities and the different colors of the lines, and they get wider as we get closer to a crisis. So the chart goes back to, I think, 2005, 2006. The only time I've seen the maturities be this spread out are 2008, 2020, and now. So the question is it happening again? And there are other signs that corroborate it. How far out are we? I don't think we're very far. People say, like, I've been around since 2020 saying the same stuff, but it's 2025. Even 5 years is not that much time. I know that's kind of a cop-out, but it's also true, and gold is still money. I mean, it doesn't really matter, because I know what the truth is. People can say what they want, but the reality is reality. It's not going to change.
Federal Reserve Chair Jerome Powell, along with political and financial leaders, may have something significant to say about gold, but for now, they're staying silent. A recently released Federal Reserve paper could almost be described as a guidebook on how struggling nations use gold revaluation to cover up financial weakness. The timing of this paper, arriving just as Powell and other officials gather in Jackson Hole, has raised eyebrows. It highlights the uncomfortable truth that gold, still officially valued by the U.S. at $42.22 an ounce, is absurdly undervalued compared to market prices. Everyone knows it, but no one in power wants to be the first to acknowledge it. The implications go far beyond U.S. shores. Countries like China and Russia, which have been aggressively accumulating gold for years, stand to gain massively if the U.S. revalues its holdings. Such a move would not only validate their anti-dollar strategy but also supercharge the value of their reserves, handing them a geopolitical and financial victory without firing a shot. What we're seeing at Jackson Hole isn't unity, but a quiet standoff. The Fed, Treasury, White House, and Congress are circling the issue, waiting for the inevitable crisis that forces them to confront reality. Do you think policymakers truly understand the consequences of revaluing gold? Or are they walking into a reset they can't control? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.